Hello and welcome to The Week Ahead, where we take a look at what economic events could have an impact on the markets this week. Today I'm joined on the line by Lena Komileva, Chief Economist and Director at G+Economics in London. So Lena, Cyprus is hitting headlines today as over the weekend Cypriots rushed to ATMs to withdraw their savings. Now the euro has weakened today as tensions build over details of the proposed bailout. Lena, can you tell me some of the greatest concerns for Cyprus and Cypriots right now, and what sort of developments should we be keeping an eye out for this week in regards to Cyprus?
Well, the key risk, of course, is that the impact of the strategy in Cyprus is not contained into Cyprus, but it triggers a broader contagion across a larger southern European economies. I mean, if the purpose of the bailout was to avoid a disorderly scenario and potential forced exit from the Eurozone for Cyprus, the effects of the stabilization strategies have been so far anything but stabilizing. I mean, for Eurozone crisis stabilization strategies to work, they need to do three things. They need to restore confidence, credit, and competitiveness. Confidence, credit, and competitiveness are needed to restore growth, and this is an integral part of any credible strategy to achieve medium-term debt sustainability. But the Cyprus deposit tax does not achieve anything. It achieves certainly neither of these three things. What it does do is it showcases the monetary liquidity is no fix for political and credit default risks, and it brings a risk premium for investors back, a risk premium that the markets had thought had disappeared under the ECB's whatever it takes promise to save the Eurozone last year.
And Lena, what other events and developments this week in Europe should we be watching out for that may actually affect the markets?
Well, the UK budget is a very important event on the calendar, of course, because it showcases that global growth debt imbalances are very much impacting government policy and economic performance outside the fixed exchange rate regime that is the Eurozone. The budget does arrive at a very controversial time after the UK's AAA downgrade, and it shows that for a government to be able to restore its fiscal credibility, you need to restore its credibility on the real economy. This is extremely difficult for an economy like the UK, where fiscal and structural impediments to growth are pretty formidable, and it highlights the need for a plan C, if you like, a plan that both reconfirms the government's commitment to a credible medium-term fiscal sustainability program, but it also it shows a greater focus on stimulating growth in the private sector to offset the exodus of public sector borrowing and spending.
And finally, in terms of economic events in the rest of the world, many will be keeping a close eye on the FOMC this week. Now, how do you think this will affect markets?
Well, there's of course a great deal of focus on what the Fed is going to do, given that the dollar is the leverage currency of the world through the structural downtrend of the last several years. It is obviously all eyes are going to be on the Fed's announcement. Now, judging by preliminary comments from senior voting FOMC officials and of course Chairman Bernanke himself, it looks unlikely that the Fed will be rushing to introduce unnecessarily, if you like, risk premium into its strategy by signaling any change in the outlook for the size or pace of its asset purchases. And of course, the Fed fund rate is going to remain flat against the zero floor targeted by the Fed. What is, however, important is that the Fed will have to recognize with its language the improving backdrop of the real economy, particularly the improvement in the labor figures, and of course we have had some ancillary positive consumer indicators in the past several weeks, such as improving credit card spending, improving retail sales. All of that suggests a nascent sort of self-sustained momentum. Of course, the U.S. economy is far from a self-sustained recovery, and many of the jobs that are being created are in the lower income bracket. Nevertheless, the Fed's policy strategy is fixed is linked to the macroeconomic performance, and particularly to the unemployment rate, and therefore the Fed may have to go some way to qualify its medium-term thoughts on an exit strategy. I think that at the time when many risk markets are technically overvalued, any potential hint of reduced liquidity support, even though that will be over the medium to long-term horizon, may have a destabilizing effect, particularly at a time when the markets are once again looking at economic, political instability in Europe because of the Cyprus situation, because of the fact that we still don't have a government in Italy. Spain is in a perpetual political crisis, and Greece is struggling to fulfill the terms of its troika bailout. And of course we have the instability on the Korean peninsula in Asia, and the pass through the continued effects of macroprudential bank credit tightening in China. So we're actually in a week that will bring a lot of data, policy and political risk, which will probably contribute to a much more volatile, choppier and risk-averse environment for the markets.
Thank you very much, Lena. So viewers, if you're interested in hearing more about the Cyprus bailout, do have a look at my colleague Jennifer Cordinley's press review on Cyprus. But for now, enjoy the rest of your day.